Good afternoon, everybody. Welcome to the second series of the tax changes. The first series we had this morning was on the corporate updates. This afternoon, we're going to go through individual tax changes in the Tax Cuts and Jobs Act. Before I start, I'd like to thank Colleen Logan from our administrative department for putting this together, as well as Mariana Mahagan, tax director in our firm, and Alan Sobel, who did the earlier presentation on the corporate tax changes, which ties into some of the changes that have occurred under the individual tax changes, Tax Cuts and Jobs Act. Okay, so what we're going to cover today are some of the most significant changes in the Tax Cuts and Jobs Act, which include one, which has been the most sweeping change of tax brackets and rates. That has been moved back and forth over between the Senate and the House version, and ultimately the reconciliation process between the two to get to the tax brackets we currently have. Originally, they were looking to do 3 tax brackets. As you will see, there are multiple tax brackets still in effect, although the rates have changed. We're going to do the kiddie tax, talk about kiddie tax, appeal of Obamacare mandate, and all the other items listed here, AMT, pass-through income, estate and gift, 529 plans, etc. This has been one of the most sweeping changes that we've had since 1980s under the Reagan administration. The tax rates are now into, before they were in 6 brackets, which was the 10, 15, 25, 28, 33, 35, actually in 39.6, actually 7 brackets. Now, with the new law, we have a 10%, a 12%, 22, 24, 32, 35, and a top tax rate of 37% for an individual. Those rates are effective starting in the next tax year, starting for tax years beginning after December 31st, 2017, and there's a sunset for January 1st, 2026, where we'll go back to the pre-act law. Now, what I've done here is I wanted to kind of show what the brackets look like by category. And you'll see under the diagram here that there is still what we would call a marriage penalty. The penalty would be, there would be no penalty if the brackets were exactly double between single and married filing jointly. But as you'll see, if you look at like the 37% bracket, 500,000 plus of income for a single filer is at 37%. But if you hit 6,000 married filing joint, you're at 37%. So if you have 2 couples that both earn $500,000, they're basically, before they were able to take advantage of all these brackets, the 10 to 37% bracket, only for 100,000 of that income will they be able to move into the $600,000 range. Everything will be taxed at 37% above and beyond. So they'll only be able to use the brackets for basically $100,000 in that 35% range. So there's still a penalty for under the marriage tax or / marriage penalty that's out there. Now, what's interesting is, in going to the next slide, the rates under the old tax, before the tax law was put into place, you could see that the top tax rate was 39.6%. At $470,000, you were at that top tax rate for married filing jointly. At $418,000, you were there for single. So there now is a $100,000 differential instead of about a $50,000 differential. So having said this, what does that all mean to everybody, who ultimately will be looking at from their tax situation in 2018? Now, I can't tell you individually what that means to you, but what I can say is that, if I took an example and kind of ran it through to take a look at what it means in each income level. For example, under the new law, if you start at $100,000 of, let's just say you're a W-2 employee, you had itemized deductions of about $30,000, and you had personal exemptions of 2 kids and yourself and your husband, wife. Now, we're going to get into the standard deduction, the new amount in a little bit, and the personal exemption, which has been eliminated. But basically, your taxes would go up 22%, but for a child tax credit increase, which is going to reduce your taxes by about 6%. If you go down the line, $200,000, $300,000, $400,000, $500,000 of income, there is a cut, and the cut actually goes up in percentage to about $500,000 of income in this scenario. For somebody living in a high tax state like New Jersey, you'll probably have like an 8-9% reduction in your taxes. Now, when you get above and beyond that amount, everything's going to be taxed at 37%. But what's going to happen is you're losing your state income tax deduction, which we're going to get into, which effectively costs you more than the 2.6% decrease in tax rates, which ultimately will shrink the amount you're going to benefit under this tax law. Now, this is for a W-2 employee only. Businesses are separate because there are other provisions for businesses that may affect your tax situation, but it is interesting to run through a scenario to see what ultimately would play out based on different circumstances. So having said that, on this slide, you see that there's a standard deduction of $12,700 married filing joint. That's going to change. We're going to talk about the change in the standard deduction in a second. Also, what I wanted to mention, which I did not mention in the beginning, is that if you have any questions, please put it through on the webinar. What we're going to do is hold the questions to the end of the session, and then I will go through the questions one by one, try to make sure we cover as many as we can in the order that they're asked as we go through this hour presentation. Of course, there's a lot of changes, so we'll try to get through as much as we can, and then hopefully allow for enough time to wrap up at 2 p.m. Okay, so capital gain provisions on the next slide here. The capital gain rates have not changed at all under the new tax law. In fact, they're exactly the same. So the rates are 0, 15, or 20% depending on your income level. Everything is retained, and the qualified dividend rate is also retained as well at those rates. Now, there's also Obamacare tax, which is at 3.8% of your unearned income if you're married filing joint over $250,000, if your adjusted gross income is over that amount. That is retained as well. That has not gone away. So that's currently still in the law. So if you have a capital gain and you're making over a certain amount, you're going to be subject to 20% plus the 3.8% Obamacare tax. So your effective capital gain rate on a federal level will be 23.8%, and that will continue. There will be no change. Kiddie tax. So one of the biggest things that back in the 1990s, the Clinton administration was concerned that a lot of taxpayers were setting up multiple trusts in order to benefit from the tax brackets of those trusts. In addition, they're concerned that people were utilizing their children to move their income to lower rates. So the kiddie tax was set up to avoid that situation. Now, what's going on now under the old law is under the kiddie tax, if you had basically unearned income of about $1,800, whatever was above that amount would be taxed at the parent's highest marginal bracket, which if they're in the 37% bracket now, which is the highest rate, that's what it would be taxed at. Beginning in 2018, for years after December 31st, 2017, taxable income for earned income continues to be at the single rate. So if your child has a W-2, they're working at, let's say, Starbucks or something like that, that's earned income, and that will be at their normal brackets. Where the problem with the kiddie tax has always been is the unearned income, the dividends, the interest, and all those types of, and the royalties, those types of income streams. Under Under unearned income, the tax brackets will be moved to the trust and estate tax brackets. And what that means is the trust and estate brackets are accelerated at about $10,000. You're at the top rate, but that's better than $1,600 or $1,800 that it was before. So your tax rates, you're going to have a little bit more ability now to shift some income, especially for the first $10,000 of income to each child for unearned income. So now there's a little bit more play than there was before in this area. So that's something that as we go through each and every one of your situations, we will take a look at to determine whether or not it makes sense to shift some income to your children. So again, there's a little more flexibility under the new law, really compared to the previous law. In 2011 or so, when they passed the Affordable Care Act, there was the requirement that individuals who are not covered by a health plan have provided at least a minimum essential coverage, and they'd have to pay a shared responsibility payment with their federal tax return if they didn't have health insurance. Well, that's been the big contention in the new bill, and that was one of the provisions that I think was, from a standpoint of being partisan, that caused a rift between parties. But having 51 senators vote for the bill, this provision has now reduced that penalty to zero. So now there is no individual mandate for health insurance to purchase health insurance. A lot of the parts of Obamacare are still in place, but the mandate is not in place moving forward. AMT. So AMT is a tax, they've called it, on the middle class. That's what it's been labeled over the years. And it's crept up on a lot of taxpayers, and where it's been in place over what we've seen in the band of about $150,000, $200,000 of income to about $700,000, $800,000 of income. When you have income that's higher than that level under the old law, your rates marginally would be over the AMT rate, which is about 28%. So as your rates become higher in average, you eventually go out of AMT and you no longer have an AMT issue. That has caused over the years taxpayers to pay a significant amount of more tax than they have in the past before the AMT was enacted, because their state and local income taxes, their personal exemptions were all added back under AMT. And there's also an exemption amount to your income that you're able to take after you add back all those amounts, but it was quickly phased out by the time you've made over $250,000, $300,000. You lost the AMT exemption, which caused most taxpayers, especially in high tax states like New Jersey and New York and California, to be subject to AMT. The new tax bill really makes AMT less of a factor. We've done some math going through different situations, and the phase out of the exemption, which is now has been raised from about $86,000 to $109,000, starts at $1 million of income, married filing joint, $500,000 for all other taxpayers. So on married filing joint taxpayers, if you kind of go through the situation, and I've taken it up to $1 million, and you also with state taxes being eliminated as far as a deduction, a lot of taxpayers are not going to be subject to AMT. Where we may see AMT come into play is someone who has a huge capital gain for a transaction during the year, and they have other income in addition to that. Well, what happened is their phase out of the $110,000 married filing joint, if they're married, might go away, which would cause them to be into the AMT tax. But for all intents and purposes, a lot of taxpayers are going to be out of AMT going forward. They're just going to pay the regular tax under the regular system. There will be a small percentage, but the percentage will be much, much lower than it was before. So that's a very positive development from an AMT standpoint. On the standard deduction, originally has always been increasing a little bit every single year. it was $6,500 per single, and married filing separately, it was $13,000, which was exactly double for married filing joint, and $9,550 for head of household pre-2018. Under the new law, starting for your 2018 returns, starting after December 31st, 2017, the standard deduction is going to $24,000 married filing joint, $18,000 head of household, and $12,000 for all other taxpayers, which is basically your single taxpayers beginning after 2018. There's no changes made to the current law, additional standard deduction for elderly and blind. So what's going to happen really, and what the IRS, or what Congress was looking to do, was eliminate, and as you'll see with more provisions as we move forward under the slide deck, eliminate most people's ability to itemize deductions and make the returns easier to file. Although with all the changes in the tax law, it looks like it's actually going to be more complicated, but this provision from a standpoint of itemization will cause a lot of taxpayers not to be able to itemize deductions, as we will see, because there's limitations on a lot of itemized deductions. We'll go through that as we go through further slides, further changes. Okay, child tax credit. So the child tax credit was $1,000 for anybody who was married filing jointly, making basically under $110,000 adjusted gross income. $55,000 for married individuals filing separately. Once you made $1,000 or a dollar over the 110, you would lose basically 5% of your credit, or $50 per $1,000. That's the way that the law works. So if you had one child, if you're over $130,000 of adjusted gross income, you would not receive a child tax credit. If you have two children, you'd have to get to $150,000 to not receive a child tax credit. Well, under the new law, starting January 1st, 2018, the credit is increased to $2,000, and also the income limitations are substantially increased before it phases out, $400,000 before phase out begins. So a lot more people will be able to qualify under the child tax credit. Now, the child tax credit is for any children under the age of 17. So anyone who has a child who is dependent under the age of 17 will qualify to take a child tax credit. Anybody who is single or head of household, the limit starts to phase out at $200,000. State and local tax deduction. This is the biggest thing in the law that caused a lot of back and forth, and the biggest stir, especially in the Northeast region and on the west side of the United States. The Tax Act has eliminated, starting December 31st, 17, after December 31st, 17, the itemized deduction for state and local property taxes, foreign real property taxes, and basically your income taxes as well, state and local income taxes, with the exception of $10,000 married filing joint, $5,000 married taxpayers, a single taxpayer or head of household. So anyone else is $5,000. Now, this is not a separate deduction, the $10,000 away from your itemized deductions that is on a separate line item. This $10,000 or $5,000 gets included in your bucket of itemized deductions. So in order to get over the $24,000 or $12,000, depending if you're married filing jointly or other categories, you will have to only put in $10,000 for all of your state and local taxes and all your real estate property taxes combined. So again, if you don't have a lot of mortgage interest and you don't have a lot of charitable contributions, you're going to find yourself limited on your ability to be able to take itemized deductions. Now, what are our clients doing right now? Our clients are doing a couple of things, and you should consult with us afterwards if you have not consulted with us on this. One, if you're not in AMT, we're looking to prepay real estate taxes for this year, for next year, for 2018's property taxes for at least the first 2 quarters, which are the quarters that have been assessed. New York came out with, the governor came out with a ruling saying that anyone can pay their whole 2018 property taxes before the end of the year in order to enable you to pay your taxes. Generally, if the property taxes are not assessed, you shouldn't prepay them, but we do have some clients who are opting to pay a full year of property taxes nonetheless before the year ends. All taxpayers are, on an individual basis, cash basis taxpayers, which means that if you do not make a payment before the end of the year, you will not ever be able to get a deduction moving forward. So if you think that you're going to be able to pay your 2017 taxes in 2018 and receive a tax deduction, you will be surprised because you have not paid your taxes on a time before the enactment of this law. And the law enacts January 1st, 2018. So one thing to look at is to prepay your real estate / property taxes before year end for 2018. The other thing is if you have not made generally we safe harbor our clients on state and local income taxes, and on the state and local income tax portion, if you safe harbor, that may not be the whole amount that you're supposed to pay in for the whole entire year for your state and local income taxes that you would owe on April 15th. Now, you may want to look at possibly prepaying all of your income taxes for the 2017 year now if you're not in AMT in order to be able to take the tax deduction for your income taxes. Of course, if you're in AMT, state and local property taxes and state and local income taxes do not matter prepaying at this point in time because you're not going to get a deduction. But what we've been telling a lot of taxpayers is why not pay it anyway, possibly if you're close? Because if you save a couple dollars, so be it. If you're well into AMT, there's no reason to do anything at this point in time. But if you're on the border, it's worth looking at to see whether your property taxes should be prepaid or state and local income taxes should be prepaid. Home mortgage and equity indebtedness. So home mortgage, has always been limited to, in the past, any qualified resident interest secured by a principal residence up to $1 million in debt. Plus, you were able to tack on another $100,000 of indebtedness for your home equity line of credit. The new bill starting beginning of next year eliminates the home equity line of credit completely. So if you're looking to take out $100,000 to build the kitchen or to purchase a car, which a lot of people have done and used it against their house, no longer will you receive a tax deduction for that. The actual home indebtedness starting after the first of the year on any new mortgages is limited up to $750,000 of principal balance on the debt. Anything above that will not be deductible as an itemized deduction. $375 for married filing separately. So that's pretty significant if you have a couple that wants to file separately, you may be extremely limited on your ability to deduct mortgage interest. Of course, again, if your debt was incurred before December 15th, 2017, you are grandfathered in for your debt. Some people have been talking about refinancing in order to put the home equity indebtedness into their principal balance of their loan. Now, that could only work if, based on a structure of interest rates going down. At this point in time, interest rates have continued to rise, so it probably makes sense for most situations to keep your debt in place, and especially, if you, with the new indebtedness, if you have any new acquisitions going forward, you're going to be limited to the 750 limit. So it's something to take a look at, but at this point in time, it looks like that benefit's going to be eliminated, home equity line of credit. Charitable contributions. So on this, there's some good news. There is some additional ability potentially to deduct charitable contributions. One of the things that has always been limited is charitable contributions to non-public charities, to like private foundations. It's been limited to 30 or 20% of your adjusted gross income. So anyone looking for a big contribution for a year has not been able to deduct in full the amount of charity that they wanted to, and that has caused, obviously, a situation where you have to carry forward your contributions. So the new law, starting 1/1/18, is that the 50% limitation for public and private charities increased 60% in total. So now you could use up to 60% of your income you could contribute as a charitable contribution. Contributions exceeding 60% are carried forward for up to 5 years, subject to later year ceilings. So the other thing that may come into play for taxpayers who contribute a lot each and every year is that their itemized deductions, which used to be phased out in essence when you've been over around $200,000 or so in the past, your itemized deductions started phasing out, depending if you were married, filing joint, or were single, or head of household, different limits for the phase out. And your charitable contributions would then be watered down, and your deduction would be less and less and less. There is no phase out of itemized deductions moving forward, depending on any income level. That has been eliminated. So whatever your charitable contribution as it is, and if it doesn't exceed 60% of your adjusted gross income, then you'll be able to take the deduction during the year. If it does, you'll carry forward that deduction to a future year. Miscellaneous itemized deductions. So these are all the deductions that went into like a big group of, your tax prep fees, your investment advisor fees, your work-related expenses, job search expenses, safe deposit box. All of those deductions are suspended going forward after January 1, 2018. No longer will you be able to deduct any miscellaneous itemized deductions. This was always added back for an AMT preference item, which a lot of our clients were not allowed to use miscellaneous itemized deductions nonetheless, but it could affect a bunch of our taxpayers. Especially, we've had situations where you could have someone who's working and they're going to graduate school and they can't claim all of their education, so they put their education as a miscellaneous itemized deduction in order to claim that as an itemized item to reduce their taxable income. That's a situation that it could affect, or a taxpayer that is well out of AMT and has very high investment advisory expenses. Those expenses will no longer be deductible. Personal casualty and theft losses have also been suspended. That's always been difficult to claim unless you had a real disaster that you weren't reimbursed from insurance. It's always been over 10% of your adjusted gross income with a $100 deductible per instance. Now, starting December 1st, 2018, unless you're in a federally declared disaster zone, there will no longer be allowed as an itemized deduction personal casualty losses. So you see the trend here is a lot of itemized deductions have been eliminated under the new law. Gambling losses. So gambling losses have always been subject to gambling winnings, but I think what people have been doing, taxpayers, is they've been taking their other expenses related to gambling, like travel and other things, and treating them as deductions. That is no longer going to be allowed. the Congress has clarified actually through this new law that gambling winnings the losses are only allowed to be deductible up to winnings, including all expenses incurred in carrying out those wagering transactions. Okay, so the phase-out limit we talked about is suspended, so that's going to help, for example, in the situation of charity. In the situation there, you're no longer going to have a phase-out, which is going to be very beneficial going forward if you have a lot of charitable contributions. Moving expenses. So moving expenses have always been deductible as an adjustment to gross income. There's a whole bunch of qualifications for moving. You have to really permanently move. It was tested under a 2-year period. Over 39 weeks during the year, you were at your new residence for 2 straight years. You qualified, and there was no clawback of that moving deduction. Also changing, there was a mileage test. All that's gone. Everything's being suspended, except for members of the armed forces on active duty. Those members of the armed forces will still be allowed to look at deducting moving expenses. Otherwise, it's been completely suspended. So this is just a furtherance of the moving expenses on this slide. Just talks about the 50-mile rule. No longer the case. Okay, so this is one of the biggest changes. Alan Sobel earlier in the day talked about the changes under the pass-through income. The pass-through income changes allow for a new tax deduction, and this goes back to the individual tax return for anyone who has a pass-through business or sharehold, which means S-corps, partnerships, LLCs, for qualified business income that you generate from that entity. This starts years after December 31st, 2017. The deduction is 20%. And basically, the 20% is going to be a separate line item that's going to be deducted. It's not allowed in computing adjusted gross income, so there's going to be a separate line item deduction, reducing your taxable income on your tax return. So if your business earns $1 million, you would be entitled to a $200,000 tax deduction. That deduction will translate in depending on your tax bracket. If your tax bracket is 37%, 200,000 times 37% is $74,000 that you would be basically saving under this 20% deduction. There are limitations under this. The limitations that are in place are 50% of the W-2 wages for the qualified trade or business. What this means is if you are a shareholder or partner, it's your allocable share of the wages of the whole entire entity. So if your entity has $4 million of wages and you have a 25% interest in the entity, you'd be allowed to allocate $1 million of wages to be limited to your deduction to $1 million, basically, which is 50% of those wages is $500,000, let's just say. So your amount would be limited to that 50% of the W-2 wages in total. Or 25% of the W-2 wages plus 2.5% of your unadjusted basis of qualified property. That was a provision that was thrown in a day or two before the bill passed, which basically allows all real estate entities to receive this deduction, which they were not allowed to before because a lot of real estate entities didn't have any W-2 wages. There are some limitations. Well, first of all, if you have a W-2, if you have an entity that earns less than, or if you're the only owner and you're earning less than $315,000, married filing joint, or it's $157,500 for other individuals, there is no limit on the W-2 wages. You don't have to look at the W-2 wages. And the exception to the rule, too, is any service businesses. If you're a service business, you don't qualify for this 20% deduction unless you make under $315,000 or $157,000 for other individuals, $315,000 married filing jointly. So, looking at that, what we know at this point in time is definitely doctors, attorneys, and accountants do not qualify for the deduction. We are waiting for regulations to come out on what is classified as a service business. A lot of our clients are going to have questions about this. I will tell you, we don't have all the answers at this point in time. I don't know how long, and our firm does not know how long it's going to take to come out with regulations to clarify all the definitions of what is a service to business and what is not a service business. It's going to be a one-on-one circumstance that we're going to have to discuss with each business owner to figure out whether or not they qualify for the 20% deduction or not. If you're under 315, it doesn't matter. You're going to qualify, period. But if you're over 315, you may not qualify. Okay, so pretty big for the hedge fund industry, carried interest. Carried interests are taxed at favorable capital gain rates instead of ordinary income rates. Before, there was only a 1-year holding period. Now there's a 3-year holding period in order for certain partnerships' interest received in connection with performances of service to be taxed as a long-term capital gain rather than ordinary income. So this may affect some industries, may not be relevant for a lot of other ones, but obviously it's something that has to be accounted for as a potential change for some taxpayers. Big provision that's a change under this law, which is very important, is the state tax exemption is moving from the 5.6 million to 11.2 million married couple. It's basically being doubled to 11.2 per person starting after January 1st, 2018, which will be indexed for inflation. So a lot of our clients may, be out of the having a potential issue upon their passing based on this new law. Some still have the issue. The state tax did not go away. There was a lot of conversation about the state tax going away under the law. Ultimately, under negotiations with the Senate, it was put back in, and now we're with double limitations, which does help. In New Jersey, the state taxes are going away too as well. So, we'll have to see under the new governor whether they come back. That's certainly a possibility. We're kind of waiting to see what his agenda is at this point. This is an interesting provision that may be very helpful for a lot of people. The 529 college savings accounts usually can only be used for qualified higher education expenses. What that means is basically college, or grad school. The 529 could not be used for anything else. This was a big item. Actually, some of the Democratic senators did not agree with this provision, and this is something that was very controversial till the end of the last day of the tax law being passed. But now, going forward, the qualified higher education expenses for elementary, secondary, public and private and religious schools can be used up to $10,000 per year, and any various expenses associated with homeschool as well. So again, clarification on how this is going to be accounted for, how it's going to be distributed out of your 529 plan, if you have enough that you have saved up. Again, remember, the 529 plans are a vehicle to put money in for education. The earnings you put in are tax-free upon distribution, the earnings that are accrued throughout the years on the original principal you put in. The principal you put in is already post-tax. So you could put in money that earns, put in $10,000, the account goes to $50,000. That $40,000 spread, as long as you now use it for any qualified education expenses, including elementary, public, private, religious school, and higher education expenses will qualify to be able to be used. There is the $10,000 limit for the new qualifications. For higher education expenses, there is no $10,000 limit to take out per year. Student loan for interest forgiveness. So student loan interest forgiveness for certain student loans was not taxable. The forgiveness contingent on working for a certain period of time in certain professions for certain employers are tax-free. Now, the new law expands this and allows certain student loans that are discharged on account of death or permanent disability also to be excluded from gross income as well. So an expansion of the definition of student loan interest is going to be helpful upon those circumstances, which are terrible tragedies. Okay. There is also a new deferral election for qualified equity grants. So equity grants, and this is a very interesting provision here. Mostly, an employee would recognize income on the tax year in which an employee's right to the stock is transferable or isn't subject to a substantial risk of forfeiture. Basically, you don't have a risk to lose those shares that you're granted. The amount includable in income would be whatever the fair market value of the stock was at that time compared to the amount that an employee would pay for the stock. Under the new law, effective after the first of the year, those restricted stock units, there's an election to defer for income taxes the recognition of amounts attributable to the qualified stock transferred to the employee by the employer. The election applies only for income tax purposes. FICA and FUTA has always been taxable under these grants. Now, having said that, what does that mean? So what there will be is a new election that can be made no later than 30 days after the first time the employee's right of stock is substantially vested or transferable, whichever occurs earlier. And the early events that will happen, if these events happen, causes an immediate recognition of income. So if the stock becomes transferable to them, including solely for this purpose, it will vest automatically as far as being taxable. There's a definition of excluded employee, which is basically, when I looked at the rules, employees that are basically the 4 highest paid employees of a company, or the CFO of a company, those type of, or CEO, those type of employees will automatically be taxable and not fall under these rules. If the stock of the employer becomes tradable on the market, that becomes an issue because now it could be readily tradable. Immediately, you're going to have tax effects on that. And date 5 years after the employee's right to stock becomes substantially vested, or the date on which the employee revokes his or her election. So again, these are some things that we're going to have to sort through to further understand how it's going to affect on any of our clients that have received restricted stock options or rights or grants. But it's something that will allow you to defer some of your income tax to a future year. Okay, casualty theft. So if it is in a disaster zone, I just got logged out. I don't know what happened, but anyway. I don't know, guys, why I got logged out here, but I guess I'll have IT come in.
Ken, we can still hear you.
Okay, so I'm up near the end of the slide deck, but the slides just stopped. I'm actually at the last couple slides. I don't know if everybody can see the slides.
We can see the slides.
Okay, good. I guess we're back online. Okay, relief from early. So let me just go back to the slide I was at, which is the casualty floor and disaster losses. So only on disaster losses are you allowed to basically take casualty loss It has to be over 10% of your AGI, and then there's a $500 amount that you have to be over at that point in order to take a deduction. So unless you have a federally declared disaster, you're not going to qualify. And this continues on, the distribution from a qualified retirement plan is another provision where there's been a 10% tax under disasters continuing. The early withdrawal fee on your retirement plan will not count for a 10% fee if you're withdrawing before you're 59 and a half years old from your qualified retirement plan in order to pay for disaster expenses. So that's a provision to help people pay for the qualified disasters that happen. This is an interesting provision, and we're near the end, so we're going to take questions in about 5 minutes, and we should have about close to 10 minutes for questions. Pre-Act law had, if the IRS levied your property, within 9 months you had a right to have your property returned. Well, that was felt to be something that wasn't enough time for a lot of taxpayers, so they extended it to 2 years. There's a little bit more requirements on tax preparers, which I'm not going to spend time on, which there's more penalties for us if we don't get enough documentation upon preparing returns. And here's something for divorce, which everybody should know about. If there is a divorce and the divorce happens after December 31st, 2018, that's very important. This is not January 1st, 2018. This is December 31st, 2018. It's only year starting in 2019 when the divorce is executed as of that date. There is no longer a deduction for alimony paid, and there's no longer a taxable item for the receiver of alimony. So the IRS is saying they're no longer going to sponsor that differential of rates where a taxpayer in a high tax bracket maybe took a 40% deduction, which is now 37%, and their former spouse received the income and paid the lowest marginal brackets on that income. That is going to be gone. So there's going to be a change in negotiations of alimony, because if the payer is not receiving a tax deduction for the alimony paid, it's going to cost that payer a lot more money to pay for the alimony. So that should be something, again, if anyone's involved in marital issues, that's something that's going to be very important. Okay, so we have about 10 minutes left. We're at the Q&A portion. Trying to take a look here to see if I have questions. Let's see. I'm trying to scroll up here and take a look. Okay, 1 second. Have there been any changes to the electric vehicle credit? I'm not aware of any changes that I have read for the electrical vehicle credit at all at this point in time. I think the credit is still in effect with the provisions that were in effect before. Okay. Colleen, if you could come down, because I'm having trouble opening the questions here, just to make sure I get all these questions. Okay, I see some more questions. I see a lot of questions here. I'm having trouble opening. Just give me 1 second. On the panel here, it's kind of like, I don't know how to.
Box. Click on the box.
This box?
Yeah.
Okay, good, great. All right, so I'm going to roll down the questions one by one. We currently own more than one house. Does a maximum deduction of $10,000 in property tax apply to each property separately or all properties owned? It applies to all properties owned. You're only allowed $10,000, period. So it's not per property. I don't understand, is the Obamacare penalty gone in 2018 or 19? Your slide made it look like 2019. I thought it was gone in 2018. I'll have to retake a look at my slide. It could be 2019. The person that asked this question, I'm going to write down your name And I'm going to recheck. Quite frankly, I'd have to go back to my slides, and I have to reconfirm that, so I'm not positive. Next question is, can we prepay the 2018 property taxes in 2017 in order to deduct them? The answer is yes. You could prepay the first 2 quarters at least that are assessed. The other 2 quarters are more undefined whether you could pay. In New York, they've said you could pay the whole entire year. Other states may follow suit, but you only have a couple of days to figure that out. Some of our taxpayers are paying the whole entire year. We definitely can confirm that the first 2 quarters are allowed to be prepaid. Is a child tax credit a per child amount or a total no matter how many children you have? It's a per child amount, so that's going to be beneficial to people who have a lot of children. Did I miss medical deductions, doctors, hospital, dentist, labs? What about a medical insurance premiums? The deduction is 7.5% now. I think I might have not put in that provision because it wasn't too relevant, but it's going to be 7.5%. And then eventually, I believe the medical is going to be, reduced drastically. I have to go back to that to figure out what that amount is. We're renovating a house and dipping into our home equity line as we go. Currently, we have an interest payment of $1,000 a month. But I understand you to say that this amount would be grandfathered and therefore deductible in 2018 or until the loan is paid off. If so, then of course the amount we borrow increases in excess of the current loan of $300,000 in 2018. The interest on the excess will not be deductible. From what I understand on the new law, home equity line of credit is not deductible, period. The only thing that will be deductible is original acquisition debt that's grandfathered up to $1 million. After the first of the year, any new debt is subject to only $750,000 of qualified indebtedness. The new 20% deduction for pass-through income, would that include real estate investment income I received through a member interest in LLC? The answer is yes. At this point in time, we believe it should include it because that is limited. There's a provision that's limited to 2.5% of unadjusted property values, or property costs. So it is included into the calculation, and you could use that amount in order to qualify for that pass-through deduction. Can a taxpayer make gifts up to the new maximum amount of 11.2 and not have them become taxed at death when the state tax exemption reverts back in 2026? So the gift, I don't think the gift amounts have changed, but the state exemption amount has. So that's something we're going to have to analyze as we move forward. Was there any impact to pre-tax employee benefit plans such as pre-tax transit, DC, FSA, HSA? The answer is yes. There was some, and we didn't cover that, but now there is some issues as far as deductibility for employers of that amount, which might have been covered on the company presentation earlier today. Employees can still qualify. Has there been changes to electrical vehicle plan? We already answered that one. Anything happening with education credits or deductions? Nothing that I know of that has changed. Does 1099 consulting income work the same as an LLC as far as pass-through? The person who asked this, I would say yes. So this is the big contention of why they had service businesses originally not qualify, and then Senator Johnson came up and said he wasn't going to vote for the bill, so they put a $500,000 provision, which ultimately made its way to $315,000. Anybody under $315,000 qualifies for the deduction. Anyone over does not. So is there an opportunity if you are a 1099 consultant to qualify? Yes. The one issue that I see going forward and seeing on regulations that might be very interesting on how people are going to qualify is whether you're an employee or an independent contractor. So if you are getting a 1099, you got to make sure that you can prove that you are not an employee in order to receive this deduction. New mortgage interest rules still apply to secondary personal residence, correct? Correct. Can any individual deduct asset management, investment management, broker, advisory, or trustee fees? Individuals cannot deduct those fees. With elimination of the equity loan provision, will it make more sense for a young family buying with a mortgage under $750,000 to move rather than add on with an equity line? That's a loaded question. I can't give advice on whether it makes more sense to move or not. That deals with a lot of issues well beyond tax laws. Are real estate taxes still deductible on investment properties? The answer is yes. So your investment properties and LLCs, you'll be able to deduct those taxes. That is it looks like, for all the questions. We have 2-3 minutes left. I will hang for another 2 minutes to see if anybody else has any questions. Otherwise, this completes the second session of the updates on the new Tax Act. Again, if anybody here on the phone has questions about this act that they'd like to go through that was not answered on this call, we are here to walk you through any questions you may have. We will say we do not have all the answers yet. You got to realize this law was only passed/signed by the president 4 days ago. We've been following it for the last month or two, which has been moving back and forth between what provision passed and what provision didn't look like it was going to pass. So at this point in time, we are still analyzing the law. We have disseminated the information to the best of our ability to provide to you, but there's still a lot more questions than answers at this point in certain provisions of the law. But having said that, if you have any more questions, please call us and we will walk you through whatever we can. All right, so it looks like that is it. Thank you very much for your time, and we hope everybody has a great new year.